Market recap. Hello, everybody, and welcome to this latest market recap. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it's a pleasure to be with all of you this weekend. Quite a crazy week in the market last week. I mean, we had Fed meeting, an announcement. We had the policy statement out on Wednesday of last week. We had Q2 GDP coming out. That showed a big surprise, showed the economy was much stronger than expected in Q2. We had a non-farm payrolls report that came out on Friday that not only showed that the economy was weakening as the jobs came in much less than expected, but we had two major revisions back. We just got the July data, but we also had revisions to both June and May, essentially cutting almost all of the jobs out in both of those months, showing that instead of having really strong economic reports, we actually had pretty weak ones. And that was not received well by President Trump, as he decided that he would fire the head of the Bureau of Labor Statistics. I mean, for me personally, I try not to get involved in that kind of stuff. I just try to watch the market and see what the market's doing. But it would make little sense to me that one person could be in, that could have that ability to manipulate numbers. But that's what President Trump claimed. But on the other hand, I can kind of see his point. I mean, this is information that's shared with the Fed, and the Fed's making decisions on interest rates. And you've got jobs numbers that are way off. I mean, these numbers weren't even close. We wiped out almost all of the jobs for the last 2 months prior to this report. So I'm not sure how the Fed can really make good decisions on interest rates if the data they're getting is the same thing that the public is receiving. Anyhow, whether you agree with it or not, the head of the Bureau of Labor Statistics was fired last week as a result of all of this. And anyway, very, it's just a week filled with trauma. I mean, looking at not only the reports, some looking good, like I said, GDP looked good, but then you've got the jobs report not looking good and the major revisions, the Fed deciding not to cut interest rates again, and they did not really talk about cutting in September. Powell essentially, I might be paraphrasing here a little bit, but Powell essentially said that's not really on the table right now for September. Now, he said the same thing last year, and come to find out, a couple weeks after the meeting, in the minutes, we saw that there had been discussions of rate cuts, and he actually went on to say that it was on the table for the next meeting. So I guess maybe we'll need to see the minutes to be sure that there was nothing talked about in terms of rate cuts. But overall, it was not a very good week for stocks. And part of that was because of the Fed. Part of it was because of the jobs report. We did have a really good lift to the market on Thursday morning after both Meta Platforms and Microsoft reported very strong quarterly results Wednesday after the bell. So that temporarily gave the market a big lift on Thursday morning. But the big problem was they were selling all day on Thursday after that great news, and it all occurred on heavy volume. So that was not good to see that kind of reversing candle going on the daily chart with a negative divergence in play. So we got a lot of things going into next week, and certainly I believe things are set up maybe to go a little bit lower, or at least to consolidate for a period of time. I'd be very surprised if this market goes right back up to all-time highs. We need to also keep in mind August and September, historically the two worst months of the year, two worst consecutive months of the year. And we are in a period historically that is the worst period of the year, from July 17th close through the September 26th close. So there's a lot of things, I think, setting the market up for some struggle ahead. And I wouldn't be surprised if we see that. I actually reached out to our members in our daily market report on Thursday, suggesting that we could be in for some trouble ahead here prior to the non-farm payrolls coming out on Friday and prior to that big down day. Things were setting up for me anyway, looking like the market was topping. And so I had mentioned I was raising cash, starting to grow much more defensive and cautious. And I think that was a good timely call because we did see a lot of selling on Friday. And I suspect we're probably going to see some more. But anyway, let's go ahead and take a look at what happened last week, and let's look at some charts. So the Dow Jones Industrial Average last week dropping 2.92%. That was, well, let me get this in order here. NASDAQ actually had the best week of all the major indices, dropping just 2.19%. S&P 2.4%. Then comes the Dow, which was up, down closer to 3%. Mid caps 3.5%. Small caps over 4%. And transportation stocks down 7.7% last week. So there were a couple of things when I look at this that kind of stand out to me. Number one, I think a lot of money that had rotated into small caps and transportation stocks and some of the other areas based on feelings that the Fed would start to turn and maybe we would get an interest rate cut. I think the Fed, once again, Fed Chief Powell, I think squashed those ideas, those dreams, whatever you want to call it, because the wording was pretty clear to me that the Fed has no intention of cutting interest rates now and in the near future. So the market, again, which I think had started to rotate more toward those areas that would benefit from rate cuts, those areas really got trounced last week. No sugarcoating it. Transports, Russell 2000, I think that they will be strong later when the Fed finally does decide to cut. But who knows with this Fed? I'm a little tired of talking about what I think of this Fed. I think they are late to every ballgame. If these adjusted jobs reports are true and accurate, then our economy is much more fragile than what the Fed has been saying. And so I don't know. We'll see what happens from here. I think that they're, given the fact that the market's gone up so much, I mean, we've risen probably 30% or more off the bottom on the S&P 500 from that April low to where we topped last week over 6,400. So that was a huge rally. And to see that kind of a move in less than 4 months, it's not unprecedented, but it's almost unprecedented. And so I think the market's set up here for perhaps some selling, perhaps some consolidation. We'll have to kind of evaluate it as we go. All right, moving on to the sectors. So it was interesting that with all the selling that took place last week, communication services was actually the second best performing group. Technology and industrials kind of middle of the pack. I mean, technology down only 1.88%. That was, less than what we saw in the NASDAQ and less than the S&P 500. So we actually saw relative strength in technology last week. You don't normally see that when you have a big, sell-off like this, especially after such a big run-up. You would think those groups that led the market to the upside would be taking the bigger hit. That was not really the case last week in terms of technology. And I think that's a positive for the market going forward. Areas that got hit the hardest last week: materials, healthcare, consumer discretionary. Amazon took a big hit after its earnings on Thursday. They were reported after the bell on Thursday. And of course, unfortunately, the market reaction was on Friday, and the market was not in a very good mood Friday. So Amazon took a big hit at the open, and that contributed pretty heavily. That's the number one ranked stock, or number one weighted stock in the XLY. And that had a big impact on that group on Friday. Still, the overall weak action, though, not great. Utilities, the only sector to gain ground last week. Completely different, by the way, than what we've seen over the last many weeks. We saw the market just continually going higher and higher and higher. We saw the volatility index, which had dropped down into the 14s, shot back up at the end of last week, finished above 20, which can be problematic. That can certainly lead to some more aggressive selling. So that's something that's on the table for next week as we start a new week. Some things to just keep in mind as we move forward. Let's take a look at the Dow Jones. So the Dow Jones Industrial Average, you can see we had closed at a higher price in mid-July. Look at that negative divergence on the PPO. So that normally will lead to perhaps a 50-day test or a PPO centerline test. Looks like we're heading toward the centerline, and we did get a 50-day test on the Dow. Moving on to the S&P 500 on the daily chart, very similar. got this big bearish engulfing candlestick with a negative divergence in play. That normally leads to further selling. That's what I talked about on Thursday to our members. And Friday, of course, we saw the big gap down in the selling. Selling could have been a lot worse. I mean, you look at the size of the filled part of the candle body, and it really wasn't that great. So from open to close, the net wasn't that significant to the downside. But we know what happens with manipulation. We get these gaps. We saw one on Friday. We'll see what happens on Monday, but I wouldn't be surprised. I could see the market going any which way at the beginning of the week, but I certainly would not be surprised by a gap down with the volatility index picking up the way that it did at the end of the week. The NASDAQ 100, same thing, bearish engulfing candle. You can see the lower PPO, higher prices. That normally, again, leads to weakness that goes beyond the 20-day moving average. And sure enough, very next day, we closed below the 20-day for the first time since back in April when we moved above it. So definitely some technical deterioration in the market last week that we all need to be aware of. IWM small caps, we did come down, print in a little bit of a hammer right on the 50-day moving average. Hopefully this is the end of the selling in the small caps. It's going to be very interesting if we do see selling. Do the small caps get spared? Because they've already taken a much larger hit. We're talking about the small caps being down back where the high was back in June. That's back at that 215 level. If we go back and we look at the NASDAQ 100, see where we were in June, we were at 22,000. Now, even with the selling, we're at 22.7. So it's that relative performance that's been so weak of late for the small caps. And again, I think the market was anticipating that we were moving toward a rate cut, and the Fed squashed it. It is important to note, though, on this from this Fed meeting, that 2 Fed governors dissented. First time that has happened in 32 years. 1993 was the last time that we had 2 Fed governors dissent. And I think that's noteworthy because the Fed, it's a brotherhood. I don't know, whatever you want to call it, but they tend to vote together. They discuss a lot of things. They may have differences of opinion in the meetings, but they try to come out of these meetings unified. And they did not come out of this meeting unified. So, at this point, the way I look at it is Fed chief can't even, rally his own troops within the Fed. So there's a lot of differences of opinion right now in the Fed as far as which way they should be going. And that was made pretty clear when the policy statement and the discussion came out on Wednesday. All right, moving on, let's take a look at the Dow on a weekly chart. Now, this is going to be interesting because the Dow, the way I'm looking at it is I see kind of an inverse head and shoulder pattern forming, which is a bullish continuation pattern where you go up, come down to the left shoulder, back up to the neckline, head, back to the neckline, and now we could be putting in a right shoulder. Maybe that takes us back down to 42.5. Maybe we stop at 43,000. I don't know. But coming back down, it looks like potentially we might have another 2 to 4% downside on the Dow to potentially establish an inverse right shoulder. And then if you go back up and you break out, that potentially could send the Dow up significantly, maybe as high as up to 53,000 on the measurement. So worth keeping an eye on for sure and monitoring. The S&P 500, as bad as the PPO was on the daily chart showing that negative divergence, we have the exact opposite here on the weekly. We're very, very bullish here. And the rising 20-week moving average right now is at about 6,012. There are a number of different support levels. I won't go over them all today in this video, but I see a lot of different scenarios for the S&P 500, and most of them show support between 6,000 and about 6,150. So that's kind of the area that I'm looking at as a potential for the S&P 500 to falter down to. Now, we're at 62.38. That's where we closed this week. So if we were to make it all the way down to that 6,000 level, we're talking about maybe another 4% downside. If we just go down and test that rising, or not the rising 20-week moving average, but if we go down and we test that breakout level, remember back in February, we set a high of 61.44. That was the all-time high prior to the cyclical bear market. We came back up. We went through 61.44. We haven't gone back down to test that level yet. So 61.44, which was prior price resistance, now becomes price support. That will be a level to watch. And that would be about another 100 points, less than 2% from where we finished on Friday. So anyway, I'm looking, I think we probably go down closer to 6,000. That's just my gut feeling here over August, September. We'll see what happens. And I'm not saying it's going to be straight down. I'm not going to say we're going to hit it on Monday. But I think in time we could consolidate. It wouldn't be out of the question to see 6,000, which again, only another 4% from where we were. And considering how much we've risen, that really wouldn't be that big of a deal. All right. Let's talk a little bit about the Mag 7 stocks, because Meta came out with a great report. Look at that huge gap up after hours on Wednesday. It carried over to Thursday's open. And you can see it was interesting because Meta, this was one of the stocks I talked about. The fact that it had pulled back, I thought we could get a breakout to an all-time high with earnings. I was looking for a gap above 745, and we got it. We opened at 775, I believe, and kind of finished right about there as well on Thursday. And then, of course, Friday, everything in the market, after we saw a lot of selling throughout the day on Thursday, we saw the gap down on Friday. I didn't like going into Thursday's close nearly as much from an earnings perspective because I did not like the chart on Apple heading into earnings. And even though we did get a gap up on Friday in Apple, there was mostly selling throughout the day and it finished down. Looked like an ugly finish to me on Apple. I think we're going to go lower there. But yeah, I mean, with the Mag 7, maybe toppy, a little bit toppy here, it's going to be hard for the market to move appreciably higher if the Mag 7 doesn't lead it. You've got a lot of stocks that are very heavily represented in the S&P 500 and in the NASDAQ 100. And if these stocks continue to meander lower or go sideways for a period of time, that's likely to dictate the same result for the major indices. So here's Meta. I can pull up Microsoft. Microsoft had a big gap up, but look at the failure, big black candle off of this uptrend. That normally is not a good thing. So I suspect we're probably going to come back down, maybe to the 20-day, maybe to just fill the gap. And then I see sideways consolidation for a period of time. NVIDIA had a big move up on Thursday's open with the news from Meta and Microsoft. And then we had a big sell-off. And semiconductors overall did not perform well on Thursday, had a big reversing candle. So I thought that was another sign that was telling me that, hey, we're probably topping in here after a huge run up to the upside. So being a little bit more cautious, maybe taking some profits, building up cash, all of that made a lot more sense to me at the end of the week. So anyway, that's NVIDIA. Let's take a look then at Amazon. So there's Amazon with the big gap down on Friday. We saw this one getting up close to its all-time high on Thursday, didn't quite reach. I thought Amazon looked pretty decent going into its earnings. So I'm a little surprised that we had such a big gap down there. But then if we pull up Apple, after gapping up a little bit, you can see the big sell-off there. I'm not at all surprised with Apple. Look at the relative strength on Apple versus its computer hardware peers. It's sitting at a 52-week low. It went into earnings at a 52-week low relative to its peers. We don't see that very often with Apple. So there's probably a lot of bad news now built into the price. I think at some point we're going to start to see it probably put in some kind of a base. And eventually, if we can get back up through the 215 to 222 area, that's where the overhead resistance lies. I think if we get through that area, Apple becomes a buy. But until then, I think you got to be really careful here with the stock. Let's see, what else do we have here? Tesla. So Tesla, you can see kind of just sideways consolidating, almost in like a symmetrical triangle with the highs coming down, the lows moving up. And so we're squeezing and squeezing in this pattern. I'm not quite sure which way we go here. with Tesla, but it does look like to me that there's at least just a period of sideways consolidation right now in the stock. And given the fact that the market probably leans toward a period of selling or consolidation, my guess is that, stock like Tesla might have a little bit more downside. Maybe we go back down the 280, 290 area to test some of these recent lows. Let's keep moving here. So if you go over to our home at earningsbeats.com, you can start your no-cost trial. You also can scroll down. We have a free newsletter. No credit card required, name and email address. All you need to do here. We've got literally tens of thousands of folks have joined us on our Earnings Beats Digest newsletter. It's free. It's educational. There are trading candidates from time to time, if you so choose. That's completely up to you. But yeah, I think there's a lot of value in this free newsletter. So make sure you check that out if you haven't already. And then finally, I just want to point out, we have a free event next Saturday. I mean, if you go down here and look at our performance in our portfolios right here, you can click here to see more of on our historical performance. Look at the model and aggressive portfolios and what we've done, not just quarter to date. And our quarter, by the way, runs from May 19th to August 19th on our stock portfolios. We do this. We go through and do a equal weighted portfolio every 90 days. And we usually put it together right at the end of earnings season. So that's why it goes May 19th to August 19th. We will have another, what we call our portfolio draft, if you will, on August 19th or thereabouts, sometime around August 19th. We'll let all of our members know the equal weighted stocks that we're going to put into our portfolios for the next 90 days. And then that'll run from August 19th to November 19th. But August 19th is after just about all companies have reported. We've had a chance to evaluate these companies, and then we decide which ones we want to hold in our portfolios going forward. But check out these results. The model portfolio this quarter up 7.31%, which is modestly higher than the S&P 500, which is up 4.6%. But check out our aggressive portfolio. It's up almost 20% this quarter versus the S&P 500 being up 4.6. That is massive outperformance. And considering that most portfolio managers can't even beat the S&P 500, the fact that our aggressive portfolio is up more than 15 percentage points in one quarter is both astounding and outstanding. But what we're going to do at this event, so let's go back to that page here, and you can see right there, you can click on that link. We are going to talk about, or I'm going to be talking about, the 2 key steps that you need to be aware of to better your stock picking. If you want to learn how to beat the S&P 500, there are ways, and this is a repeatable, simple process that we go through. And I'm going to talk about it next Saturday. So make sure you come in, you click on that. When you click on that, it'll bring you to this landing page. All you have to do is put in your name, email address, and hit that submit button. And if you want to scroll down, you can read a little bit more about what we're going to be doing and how the portfolios have performed and so forth. If you are on a mobile device, you now have on your screen a QR code. So if you scan that QR code, it'll take you to the landing page where you can sign up on your mobile device. We're going to try and make this as easy as possible. Now, if you cannot attend live next Saturday, don't worry about it. You still register because we will send you a copy of the recording. If you don't register, we have nowhere to send the recording. So we need your email address. Make sure you sign up, name and email address. I hope to see you next Saturday at 10 a.m. But even if we don't, we'll send you a copy of the recording. So make sure you check that out. All right. Industry groups. So I wanted to talk just for a couple seconds here, minute or two, about the areas of strength and weakness last week, because the market took a big hit. Haven't seen that in a while. And so we wanted to see, okay, what's leading the market and what's lagging the market? Which areas of the market have been most impacted? Now, as you might suspect, we have some defensive areas, utilities, real estate, consumer staples. There's that's tobacco. But I mean, if you look, here's discretionary, here's financials, Here's industrials. Here's technology. The electronic equipment group, which has been one of the best groups by far off of that April low, still managed to outperform the S&P 500 by 3.5% last week. Folks, this doesn't happen in a truly bearish week. I mean, if we were really looking to go a lot lower in the market, you would not be seeing money rotating into electronic equipment. That's a very high growth area of the market. How about home construction? Home construction, one of the better performers last week. Internet stocks, again, loaded with growth names. These should not be on the first page of the industry group winners list from last week. And the thing is, if we go to the bottom and we look at what was lagging, I would have been looking for software. I would be looking for semiconductors, internet stocks, maybe a lot of the retail name groups. Look down this list, top 10 or 15 right here. None of that is on this list. None of it. The growth names aren't on this list. I mean, there's trucking. We talked about transportation. That's bad. So trucking's on here. There's airlines. But if you just look at these other groups, coal, tires, aluminum, containers and packaging, non-ferrous materials, delivery services, durable household, paper, marine transportation, none of these are growth areas of the market. So there's going to be all kinds of negative spin coming up this week. It started last week, end of last week. We're going to continue to get that spin. I'm telling you right now, follow the charts. Don't follow the media. The media they need clicks. They're going to write headlines that are bearish. They're going to talk about how bad things are going to get. We're probably going back down to that April low. There's going to be all kinds of crazy headlines. Stick to the charts. Watch what's going on. The rotation right now is nothing like what we saw back in February and January. Nothing at all like it. So don't think that this is April reincarnated or March and April reincarnated and that this is going to be another cyclical bear market. I do not see that happening at all. I mean, anytime you get the volatility index moving up, which it has been, yes, you can get some quick sell-offs, scary sell-offs. Market drops 2-3% in a day. Maybe we even go down 5% intraday and then rally back some. I don't know. I don't know what's coming. But all I'm telling you is that Wall Street's not preparing for a big drop. It's not something that's going to last long, in my opinion. We'll see. A couple of charts just to keep in mind. Look at home builders. Home construction really is shaping up nicely. Got a big pop on Friday, probably because of the weak jobs report. That brought interest rates down. I think we'll see mortgage rates drop in the week ahead. And so we're starting to see, but I can tell you, pending home sales last week were horrible. The FHFA house price index, awful. Case-Shiller home price index, awful. Construction spending was horrible. All this bad news is coming in the housing group just when we're trending higher. The stock market, remember this, stock market always looks ahead. So the stock market is looking to lower interest rates down the road, and that's why home construction stocks are starting to move up in the midst of horrible home construction economic reports. Doesn't make a whole lot of common sense, but this is the way the market works. The market is looking ahead. And that's why the stock market's going to rally back to all-time highs again later after we get through this potentially, I'm not sure what the right word is, challenging period ahead, August, September. That's when the market historically does its worst, performing. So we'll see if that's the case. Anyway, let's keep moving here. Here's the internet index. So internet on Thursday went up to another new all-time high, taking out the February high finally. But then, of course, the market topped. We reversed. I think maybe we go back down for a little bit. Maybe we get a 20-day test. But I'm licking my chops. I want these growth stocks to come back down some more because I can tell you, and I'm going to jump ahead here a little bit, but this is our raised guidance chart list. And I want you just to focus here on the fact that we have 455 companies now on this raised guidance chart list. I don't know if that's a record, but it's got to be close. I don't know that we've ever been at a point in time where we've had so many companies raising their guidance at once. Does that sound like a market getting ready to go into a bear market? So keep some of these, the truth of what's going on in the market in mind over the next couple of months, just in case the market goes lower and we do see a lot of bearish headlines, because the picture I'm seeing that's being painted under the surface is one of a lot of bullishness. And so if we do pull back this next month or two, we're going to have another big opportunity going into year end. Anyway, I hope you had have a great rest of your weekend. Let's be careful in the upcoming week, and then we'll be back next week to check it out and see where we stand. Have a great week, everybody. Happy trading.